This is Daybreak Asia. We're counting down to Asia's major market opens. And Haidi, perhaps investors just going to be breathing a little bit of a sigh of relief. The Fed keeping rates steady, slowing the asset runoff as well. A bit of a holding pattern, but it's still perhaps better than a hike at least.
Yeah, and of course, all of this still feeding through the big move that we saw in the yen, right? And the question again, did they or didn't they intervene to see that kind of big reaction? Perhaps we won't know, given that officials are still kind of staying mum on that.
Yeah, that's right. We heard from Canada earlier saying that we'll find out at the end of the month in regular reporting if indeed Japanese officials did step into the market in the last few minutes of New York trading here. But that Japanese yen very much the focus today, as much as a jump of 3% against the greenback over the past couple of hours. Today, though, or this morning, just a little weaker against the US dollar here, trading around 155.7. Japanese currency very much reflecting the dynamics between the BOJ and the Fed. And again, the expectation the BOJ is going to be staying easy, very accommodative over the coming months, being reflected in those latest meeting minutes for the March one, saying that mostly members that they expect financial conditions to stay easy here, and still that they will be making decisions based around more domestic factors, things like the economy, and also whether we see price pressures and any sort of build there being sustained. Japanese equities a little bit under pressure so far today. The Nikkei 225 down 0.7%. The US session, again, a little bit mixed overnight. We did see that initial relief rally, but into the close, it was that story of chip and AI hardware names really weighing on the market, the likes of AMD and Supermicro. Let's switch, because it's not just Japanese government officials that are concerned about the currency direction. You've also got Korean ones as well, saying that they will be taking bold steps if market volatility does increase alongside the BOK. And they're going to also be closely coordinating the government and the BOK amid those various uncertainties. Really does come down to the direction of Fed rate cuts, and also just how constrained some central banks in Asia could be against what the Fed does, given that we actually are seeing inflation receding in many parts of the world, Haidi.
We'll see sort of that reaction across FX, right? A little bit of a sigh of relief for Asian FX as we see that pull back in the dollar. But now that the Fed is done with, they're seeing Asia really this morning still sort of suffering the after effects, if you will, but looking to those PMI numbers a little bit later as well. Remember, a lot of these PMI readings across the different countries have been languishing in contractionary territory for quite some time. But let's get you to the side of the staggered open here in Sydney. Of course, it's always difficult to get a real read, but we are seeing a pretty flat start to trading at the moment. Just a couple of minutes as we get that staggered session coming online. The previous session was not a great one. In particular, we saw quite a bit of weakness across energy and some of the metals as well, base metals, seeing some declines going into the Fed. But we have seen, interestingly, a little bit of pickup in the price of iron ore. So we'll watch some of the big miners in the session today. Not unsurprisingly, Australian bonds are following the kind of a bit of a relief rally that we saw in treasuries overnight. And the Aussie dollar holding pretty steady at 65.29. Again, we'll be looking at some of those Asian currencies. The move in the yen obviously dominating, but there will be a bit of a breather, a chance for a breather for some other Asian FX that have been under pressure as well. That's a picture when it comes to treasuries. And of course, it is really down to that less hawkish than expected delivery of the message from Jay Powell. Take a listen.
We do not expect that it will be appropriate to reduce the target range for the federal funds rate until we have gained greater confidence that inflation is moving sustainably toward 2%. So far this year, the data have not given us that greater confidence. In particular, and as I noted earlier, readings on inflation have come in above expectations. It is likely that gaining such greater confidence will take longer than previously expected.
Let's bring in Stephen Ricchiuto, who's the Chief US Economist at Mizuho Securities. He's here with us in Sydney. In Hong Kong, we're also joined by Mixo, who's the Asia Equity Strategist at JPMorgan. We appreciate your time, both of you, for joining us. Stephen, I'll start off with you. So since December, we've had sort of wild market expectations, right? Super dovish, and now fearful of, more hawkish and a rate hike. Do you think Jay Powell got it right in the delivery of the message and the nuance?
Well, I think Jay Powell got it right in terms of the delivery of the message. What amazes me is the bond market's reaction to the message, because the message is essentially, you thought we were going to be considering tightening monetary policy, and we're not willing to do that. And you thought we were going to do it because there's an inflation issue. And we're not willing to do that. So therefore, I'm a little bit surprised that the long end of the curve hasn't moved up higher in yield as a result of what the Fed did yesterday. I think he's telegraphing the message of the committee, which is basically they don't want to raise rates anymore. They really, really, really still want to cut rates. The reality is the economy is not letting them do that. And the net result is bond yields should be higher. The curve should steepen from the long end, not from the front end.
And Mix, I'll bring you in as well. What was your reaction then to Powell's messaging during the presser?
Yeah, I think it was very important that Powell clarified that they are not considering rate hikes, because this was one of the big concerns for the market going into this FOMC. And if you think back a few months, it was really that November-December pivot when the Fed started moving away from a bias to hiking to a bias to cutting, and that bias still remains. So we can see some months of data volatility up and down, but unless that changes the Fed's bias, I think the equity market setup is quite positive. So that, to us, hasn't changed with the FOMC.
Stephen, you know, when you take a look at the dichotomy that we still see in the economy, right, historically restrictive rates environment versus still relatively stimulative fiscal environment, is there more that the Fed can do about that? And in that environment, what does persuasive evidence look like, as Jay Powell put it?
Well, there's a correction I'd like to make there, because everyone is saying there is a restrictive monetary policy. Monetary policy is not as restrictive as 525 to 550 basis points worth of rate hikes imply, because that's based on the belief that the new normal period, the period after the financial crisis prior to COVID, was normal. That was an anomaly. That low level of nominal interest rates is anomalous. The economy is actually transiting back to a higher sustained level of nominal interest rates. So therefore, the monetary policy that's out there is not as restrictive as people and as the Federal Reserve thinks it is. In addition to that, fiscal policy remains enormously stimulative. Look at the Treasury. They just announced on Monday, New York time, that they're going to borrow an extra $1 trillion between April and September of this year. $1 trillion more. They're showing you they're spending money aggressively. And in that environment where fiscal policy is very, very loose, monetary policy is really not restrictive, it explains why this economy is so resilient. This economy is resilient because it's fundamentally healthy from a balance sheet perspective, and it's getting the benefit of fiscal stimulus that's not being worked back against by monetary policy restrictiveness.
I'm glad you're bringing the deficit numbers, because they're really quite stark, you know, against the broader picture, right? So I know that you've been fairly contrarian. You've said that they'd hold. There would be no easing. Do you think they now need to hike?
Well, the reality is time will tell us whether or not they will or not. But I think the concept that they're going to be cutting rates still hasn't come out of the market. And that needs to come out first. And it needs to come out not only for 2024, but it needs to come out for 2025 and 2026 as well. So there's further adjustment that still needs to take place before we even begin considering whether or not there's a risk of them raising rates. So we're a long way away from that particular decision. And I think the market was too presumptive to think that could happen. And therefore, the fact that they did jump to that conclusion tells you the market is worried about inflation. So then when they didn't get it, why didn't they sell off the long end of the curve? That's the problem. That's the mistake. The misprice in the markets is the long end of the Treasury curve.
There's what Robert Kaplan earlier spoke to us about, the ground zero when it comes to who's being really impacted, right, by the rate regime. Can the Fed do any more, and how much are they restrained by that demographic, which is clearly struggling, and you're starting to see that come through in the consumer picture?
Well, there is certainly a demographic down the income chain that is suffering from the inflation. The problem is they're suffering from the inflation, not the interest rates. So the reality of the situation is the inflation is their biggest problem, because real disposable income is very far below trend prior to COVID. And that's a function of the COVID inflation. And the reality is that's what's hurting the consumer, not the interest rate story, because no one borrows really at the front end of the curve. Most households have the lowest net service burden since 1979, when the Fed first began calculating. Not only that, this government keeps on freeing up student loan commitments to household, which is the second largest component of household debt beyond their mortgage. The reality is their mortgage rates are fixed, and then we're freeing up their student loan debt. It's not the interest rate. They're not suffering from this rise in interest rates. What they're suffering from is the deterioration in purchasing power. And therefore, the Fed should be focused on containing inflation, not focused on keeping an economy hot, trying to maximize social welfare by maximizing employment.
So, Stephen, do you think the Fed needs to be more concerned about downside growth risks or upside inflation risks here?
The Fed should be more concerned about upside inflation risk than downside growth risk. Look, the economy is going to slow from last year. Last year's 3.1% Q4 over Q4 growth number is abnormally high. We're going to be closer to 2.5% this year, which is still 0.5 higher than the underlying trend. And that's baked in the cake already. The Fed really needs to shift its focus back to inflation as opposed to its average inflation target regime that is adopted, where it's more concerned, it's asymmetrical in their concern towards the labor market than they are to its inflation.
Mixo, what are your views on Fed policy then in the backdrop of what Stephen's been saying there?
Yeah, so I think that the Fed has been pretty clear that they see the disinflation process still continuing. And Powell seemed pretty comfortable with inflation staying in this 3, slightly under 3, or core PCE at 2.8%, that sort of range, as long as it is asymptoting. Unless you're talking about a change in trend and inflation really accelerating higher and the data completely disagreeing with the Fed, which we are not at, what really matters then is what the Fed thinks of this data. And that's, like I was saying earlier, is what we got clarity on at this FOMC meeting, where Powell was very clear that they see the data still as being comfortable and collaborating with their view. It's just taking a little bit longer. So at JPMorgan, we still have the first cut coming in July. And we have cuts thereafter into 2025. So that remains our house view at this point. From a bond yield perspective, yes, we do think that they kind of remain stuck or drift higher, again, depending on the Fed view a little bit. But if you look at the into 2024 and then into 2025, we do see room for bond yields to decline as well. Bringing this to the equity market, the way we try to figure this out is try to understand from market pricing what sort of scenarios the market is entertaining and pricing at. And really, since the pivot in November, we've seen a significant Goldilocks pricing from November all the way until March. And since then, we've seen 2 scenarios emerge simultaneously while Goldilocks kind of dies. And those 2 scenarios are, firstly, a higher for longer, a re-emergence of higher for longer. And secondly is the increasing probability of some sort of an AI bubble. And these 2 things are somewhat inconsistent with each other, so one of this will eventually fade. But for now, we continue to see the pricing move in this way, where the market is entertaining both these scenarios. So this barbell of AI and value in the equity world does really well.
Stephen, we saw the big move in the yen and, of course, Japanese officials having to come out and neither confirm nor deny if they were behind that. You're in Asia. You must get asked a lot about the impact of and the trajectory of the US dollar. Do you see this as being purely a BOJ-Fed divergence story? Is it a US exceptionalism story still?
No, I think it is a divergence story between the monetary policies. But again, I think the thing that people keep on missing is that the inflation story is actually higher than the Fed's target. And therefore, in a world where everyone is targeting 2% inflation and consistent with a 2% inflation target, we can contrast currencies based on relative nominal interest rates at the front end of the curve. In an environment where you have one central bank, in particular the Federal Reserve, that's implying and clearly said yesterday, he's comfortable with inflation at 2.83%. That's giving you a lower real yield in the U.S., and the reality is the dollar should actually be moving lower in this environment, not higher. And it should move lower against the yen, it should move lower against the euro, and it should move lower against the Aussie dollar, and it should move lower against the Chinese yuan. The Federal Reserve is not living up to the commitment on inflation that other central banks are, and it's time markets hold them to task for it.
Mixo, yen depreciation, of course, we've always seen it. Typically, it's been a positive for Japanese equities, given so many exporters on the benchmark, heavyweights there. But do you see that that correlation starting to slip a little bit.
That is exactly what is happening here, actually. If you look at the yen correlations to equity markets and to real wages and to the macroeconomy overall, we do see kind of this level at around 157, where this correlation starts to flip. And so while, yes, you're right, that yen depreciation has been positive for equities in yen terms, although, of course, if you look at it in dollar terms, the Japanese market hasn't been doing that well. But in yen terms, it should be quite positive. But above 157, it starts to become more problematic. And this is where we think that if you look at the Japanese equity market overall, the outlook for that in the near term has become a little bit more challenging.
You mentioned, though, that exuberance around AI, and it does extend. So how does that sort of also play into the picture? And is it also playing into your thinking for other tech-heavy markets in this part of the world? Yeah,
that's absolutely right. So if you look at the AI upside that we're seeing play out across the tech space, and it's not just the semiconductors, right? You got the semiconductor equipment, you got the packaging materials, you got the power and cooling makers, you got the networking equipment, you got the grid players. All of this I would qualify as a broader AI theme. And all of these stocks are doing well, and we expect that they will continue to do well. If you look at traditional price patterns heading into typical bubbles, we're not quite there yet in terms of either, if you look at any subsegment of the AI space overall, or if you look at the Mag 7 in the US, we're not quite there yet. So that translates into upside into markets like Taiwan, and especially the tech space there, into markets like Korea as well. Again, the tech space there with memory as a big exposure to AI.
You mentioned bubbles, and it makes me think as well of what's happening in the Indian equity market at the moment. What are your views? The moves that we've seen, will you continue to see investors putting their money there? Or do you think, given the outperformance we've seen, is it time to sort of reallocate again back to China instead?
It's funny, though, that everyone assumes naturally that because the Indian market has done so well, that everyone must be super overweight the market. But the reality is the complete opposite, where the entire Indian equity market rally has been driven by local buying, domestic buying. Foreigners, in fact, have been left behind. If you look at foreign buying into the market, it's kind of flatlining in 3 years. If you look at global funds, global ex-US funds, they are massively underweight India, because in their mind, A, EM is China, so when China is doing poorly, they're not looking at EM at all. And B, their assumption is that the Indian market weight is the same as it was 10 years ago. So they still hold the same stocks, same number of stocks, but the benchmark weight has gone up, leaving them significantly underweight. So we estimate that if all of these global guys simply close their underweights in India, that's $100 billion of inflow into the equity market. So there's, from a flow perspective, as if the domestic support side stays supportive, there's a lot of foreign buying to come into the market. And as you talk about, bubbles and valuation peaks, we don't see the Indian market at a level where you would qualify that as a bubble just yet. If you look at any of the historical bubbles at a market-wide, not sector, but at a market-wide level, it never peaks below 35 times. So 35 is the bare minimum you need to get to call it like a bubble top.
Belle was just alluding to the kind of green shoots or signs of life we're starting to see from China and certainly Chinese equity markets. But I do wonder, as you travel through Asia, how much are you being asked about November, what happens after November in the US, and how that impacts, in your view, how trade relationships, how economies like China, like Australia?
Well, I mean, I think the trade story is over and done with. I think everyone gets the story on China, and that is now a ship that's set sail. It's not going to come back to port anytime soon. So the hollowing out of China is something that I think continues on an ongoing basis, whether it's from a domestic standpoint or whether from the global standpoint. Supply chains are being diversified. We're building chip plants in places like Japan, and we're giving the Philippines money in order to expand chip production to diversify away from the Taiwan risk exposure and to have it in places where we have secure supply chains. So that story, I think, is permanently gone. The bigger picture that your question comes down to about the election story itself. And does anything really change from a policy standpoint once we go forward? From a trade standpoint, the answer is no. From a domestic political standpoint, the answer is yes, in one regard. They're spending money like mad, and they're going to spend even more money post the election. So that really is the underlying motivation. All we're arguing between who gets into the White House and what form of government do we have, is it divided or is it a single party rule, that we wind up in an environment of how they spend the money. and how quickly they can spend the money. Clearly, the Democrats will be able to spend the money more quickly because they basically want to do transfer payments, which are very easy to do. A Trump administration wants to do different things. But the reality is either of them, both of them, are actually going to be willing to cut taxes. And they're only going to have 1 year because neither of them is a new person coming into the White House, and therefore there'll be a lame duck after 1 year. So they'll have one set of programs, and then they'll continue to play around the periphery with regulations and executive orders and things of that nature. But they'll have 1 year to get things done.
Jay Powell's got his work cut out for him then. Stephen, really great to have you with us. Stephen Ricchiuto, who's the chief US economist at Mizuho Securities, and of course also Mixo joining us in Hong Kong, Asia equity strategist at JPMorgan, reacting to the Fed. You can get that roundup of the stories to get your day started in today's edition of Daybreak. Bloomberg subscribers can go to Daybreak Go. That's on your terminals, also on the mobile, in the Bloomberg Anywhere app. You can customize those settings too, so you just get the news on the industries and asset classes that matter to you. This is Bloomberg.
Some of the latest corporate stories we're following this morning, and JPMorgan is expected to pay an additional $100 million for its trade monitoring gaps. Sources say this is to settle a new complaint from the US Commodity Futures Trading Commission. JPMorgan earlier agreed to pay over $300 million to two other regulators, including the Fed, as its settlement over gaps in its trade surveillance program. Barclays has begun cutting hundreds of jobs as the firm embarks on a massive cost-cutting drive. Sources tell us the cuts will impact several hundred staffers in global markets, investment banking and research. Barclays is seeking to cut £2 million of costs as part of the CEO's plan to boost returns. National Australia Bank says it will buy back up to 1.5 billion Australian dollars of its own stock. The lender's cash earnings fell 13% in the 6 months ending March 31. CEO Andrew Irvine says disciplined execution of strategy helped the bank manage the impacts of slowing growth and competition. Irvine took charge of NAB last month and appointed Rachel Slade to head the firm's business bank. Quick check on how European futures are opening this morning. You are seeing a bit of weakness creeping through for Euro stocks and DAX as well. That is following the Fed decision, and we did see US equities initially posting a bit of a relief rally. The Fed not expecting to hike anytime soon. Cuts also still the expectation, the question just being when. But still, we also saw weakness around AI hardware stocks in particular. We'll have more ahead. This is Bloomberg.
You're watching Daybreak Asia, the latest across geopolitical headlines that we're monitoring. And America's cybersecurity agency warns that so-called pro-Russian hacktivists are attempting to compromise computer networks in North America and Europe. A senior official says hackers have targeted small-scale technology that controls industrial equipment and processes. This includes water and wastewater sectors, as well as dams, energy and food and agriculture. New York police have arrested almost 300 people breaking up escalating protests over the Israel-Hamas war at two colleges. The arrests were made at Columbia University and City College of New York. Police officials say outside agitators had joined the Columbia protests but are still determining how many non-students were arrested. Bloomberg has learnt that the US and Saudi Arabia are closing in on a historic pact offering the kingdom security guarantees and a path to diplomatic ties with Israel. Sources say officials are optimistic that a deal can be reached within weeks, but obstacles remain. Israel is expected to be offered a choice to join the deal dependent on ending the Gaza war and agreeing to a path toward Palestinian statehood. Well, of course, those negotiations and that potential deal weighing on commodity prices as we continue to watch a little bit of an upside when it comes to oil prices, 0.3% higher for Brent. New York crude just over $79 a barrel, though. We did see that slump with that jump in US crude inventories to the highest since June, adding to concerns about the demand side of things. 7.27 million barrels were added in US crude stockpiles last week. That's the most since early February. Also watching iron ore slipping a little bit, but of course coming off the biggest monthly gain since late 2022, with some of the optimism that perhaps the Chinese data is through the worst. Plenty more to come here on Daybreak Asia. This is Bloomberg.
The whole game plan is basically unchanged. We're going to keep rates here until we're highly confident that we're going to get inflation down to 2%. No hint whatsoever of a rate hike.
I think there's a lot of relief here that the chairman stayed true to what we've seen from this chairman.
I think Jay Powell was particularly disciplined here. I think he stayed on message very well. There's a clear bias towards easing, and he stuck to that.
They've left wide open the question of why has progress been less than they expected on the inflation front.
Let that tight policy work for longer. I think that's about as far as they're ready to go today. That's hawkish in May. We'll see what hawkish might look like in June.
This is really good for the markets because here's a Fed that's telling us, look at the longer term. Look where inflation was and look where we've gotten it to. Don't worry about the last couple of months. We'll see what happens there.
That was some of our latest guests there reacting to the Fed decision. And just taking a quick check on markets here. We're 30 minutes into the session now for Sydney, Seoul and Tokyo. And the mood here is tilted to the downside. So you've got most stocks in the region under pressure, really feeling the brunt of that in those more rate-sensitive sectors like consumer staples, consumer discretionary, IT as well. As we said, Jay Powell not as hawkish as had been perhaps feared, but still we did see tech also playing into the picture given that slump in AI hardware names like Supermicro, like AMD, Haidi, into the close.
Take a look at, as we mentioned earlier, of course, Asia PMIs is the focus for markets after the Fed, as we've seen a number of these really languishing in contractionary territory and really casting doubt over the strength of the economic recovery and how we're sort of proceeding in this final leg of the rate cycle. This is a picture, and we're seeing some deterioration when it comes to Indonesia, for example, falling from 54.2. We're also seeing deterioration for South Korea, still under that 50 level that demarcates really that contraction that we continue to see. Weakness, albeit some improvement in frontier markets like Myanmar. For Taiwan, we're seeing a flip to above 50, and Vietnam also above 50 as well. So some sense of improvement across some of those economies with the manufacturing PMIs, I should clarify. And of course, currency has been one of these aspects that have been troubling a number of these Asian FX that we've been following. And the yen has seen the biggest surge in the reaction post-Fed this morning. The big move of 3% in just minutes during the last minutes of the New York trading session. That fueled speculation that Japanese authorities intervened for a second time this week. Let's bring our FX and rates reporter, Michael Wilson. We heard from Kanda. I guess we'll find out in due course from the data that's released in a month. But did it have the characteristics of intervention?
You know what, Heidi, it actually did. It was the price action and the way that I spoke to a couple of chaps in New York before they went home, and that what they described or what they saw was much like what happened on Monday. And, you know, a situation where, you know, dollar yen was, say, around 155.70, just pick a number, you know, suddenly offers would come in, some of which came from Japanese banks, all the way like 20 points through the level, at least 10 points through the level. Now, that's not typically how the Japanese banks, you know, clear their business. It does seem predatory in terms of the, you know, the effect on the market. And I think that, I was actually skeptical. I thought they might have, after Monday's effort, I thought it might have just been, the authorities checking rates, just asking for levels, which is like a precursor to intervention. But since then, having heard what transpired, after the Powell press conference in New York, I think that, the ducks are starting to quack a little bit louder, and it's starting to appear more and more like intervention. Having said that, I don't think they're going to be happy at all with the way it's recovering so well and so quickly. We're up near 156 after hitting that 153 low. 153.04, I think it was, in New York. Didn't spend any time down there at all. So there's obviously a lot of residual demand for it. But as far as the intervention question is concerned, I think it's becoming apparent, although like you mentioned at the start, we do have to wait to the end of the month to get confirmation one way or the other. Cantor did push back. It wasn't cagey or anything like that. He didn't want to be drawn into any sort of commentary about it, and that's fair enough. But that does leave dealers who are incredible conspiracy theorists to draw their own conclusions, and they'll as soon as if you're buying dollar yen and suddenly you get given your dollars by a Japanese bank, you probably spin around and sell them straight back out and get on with it and try and see how low it goes. Because currently that's just been the way of it right now. Further out, I think that sorry.
Well, I'm curious, further out, which way do you think the yen's going to go? Are we looking at 150 to the dollar, or is 160 more in play? That's the M-Life question of the day today.
There is a lot of actual buying from customers, fund managers, real money, macro funds, to buy dollar yen from like 152 and below down to about 149. And that 152 level more or less was basically where we took off from that hot US CPI level. And so it sort of gapped up, never came back, and it's working its way back down there now, eventually, perhaps. So I think the market has still got that propensity to buy the dip. And if you look at the options market, the risk reversals in dollar yen for like the 1 month period, they're actually cheaper. Well, I think they hit a 1 month low yesterday, and they're not far from there now. So I think that the 160.17 high we saw on Monday, that's still very much in play.
That was our FX and rates reporter, Michael Wilson there. Let's shift tack to the cryptocurrency world, because the Binance founder, Zhenmin Zhao, says he will remain a passive investor in cryptocurrencies. A US court in Seattle sentenced Zhao to 4 months in prison for failures that allowed cyber criminals and terrorist groups to freely trade on the world's largest cryptocurrency exchange. While the sentence was far below the 3 years prosecutors had sought, the outcome closes a long-running probe for the Justice Department. Let's get more on this now and bring in our next guest. Dennis Kelleher is co-founder and CEO at Better Markets, a non-profit that supports stringent financial regulations. So, yes, Dennis, the sentence far below what was requested, but it is the first time that we've seen a CEO go to jail ever for a Bank Secrecy Act violation.
Well, that's true, but it's also the first time we had a crypto kingpin who created a crypto money laundering superstore for the most despicable global criminals in the world. I mean, it is true that he's the first one to go under this charge. On the other hand, he is an outlier in terms of the extreme criminal conduct that was money laundered through his company. Even a compliance officer at Binance said, Binance needs, quote,
Dennis,
a banner is washing. Sorry,
just some of the language used there, it's quite colourful, and we don't actually have evidence of those allegations.
Well, in fact, if you read what the Secretary of the Treasury said, Janet Yellen, at the press conference, that more than 100,000 suspicious transactions appear to have gone through Binance, and they included everything from drug trafficking to sex trafficking to sanctions evasions for Russia, Iran, and North Korea, as well as numerous other sanctioned individuals and groups like Hamas and Al-Qaeda. So that's all in the press conference and in the indictment. Now, it's true that CZ was only charged with a failure to have an effective money laundering program. but that's because the Department of Justice decided to charge him with a very minimal charge, which is it's an extreme disparity between the allegations of the criminal conduct that the money was laundered through Binance. Binance pleaded guilty and admitted to those charges. CZ was the founder, owner, and leader of Binance.
Again, just to reiterate, this is CZ who has gone to prison now, will be facing prison time of 4 months. He has been charged with Bank Secrecy Act violations. I understand that you're making various other statements or allegations around misconduct, but that hasn't been proven by the judicial system. But broadly, do you think that the outcome of this case or the court system sends a message to the crypto world?
Well, just to be clear, Binance did admit to the allegations. CZ pleaded guilty to just one count of Bank Secrecy Act. So it's not the allegations, they're not allegations asked to Binance. They were admitted to, which is why Binance was fined $4.3 billion and will have a monitor for 5 years. Unfortunately, I think the message this sends is that crime pays. I mean, CZ himself said better to ask forgiveness than ask permission, which is to say better to break the law ahead of time rather than to comply with the law, break it and ask for forgiveness. And that's what happened. His plan, appears to be his plan from longstanding, is that he engages in this conduct, he gets caught, he gets a very minimal sentence, he goes to court, he pleads for mercy, he has all his friends talk about what a great guy he is, and he talks about turning over a new leaf and going into philanthropy. Well, everybody says that when they're facing a judge who could send you to jail. And so he's going to go to jail for 4 months. He gets to keep his $43 billion. He's number 29 on the Bloomberg billionaires list. That money has been accumulated through Binance, and Binance admitted that it is engaged in years-long violations of all sorts of laws, and Binance facilitated egregious criminal conduct. And so, unfortunately, our concern at Better Markets is that that actually encourages crime. Individuals have to go to jail. The only person at Binance who was even charged for all of these crimes was the single person who's the CEO, and he should have been charged. He should have actually been charged with much stronger crimes, and he should have got a much bigger sentence. But they should have also charged many other people, because CZ didn't do this on his own. There's dozens, if not hundreds of others. And as I was saying earlier, one of their compliance officers actually publicly said they should hang out a banner, quote, "Is washing drug money too hard these days? Come to Binance," close quote. That was a compliance officer at Binance. They were in the business of laundering money of global criminals, and to be fined $50 million by the DOJ, which was 0.01% of CZ's net worth, and to be sent to a relatively comfortable federal prison for 4 months it's not even a slap on the wrist, and that's going to send the wrong message.
That was Dennis Kelleher there, co-founder and CEO of Better Markets. Thanks so much for your insights, and we'll have more to come on Daybreak Asia. This is Bloomberg.
We're watching shares of DBS when trading in Singapore gets underway in a few minutes' time. And Southeast Asia's largest bank reporting a profit beat. It continued to benefit from higher lending income and strong wealth management fees. Our senior Asia finance reporter Chan Joan joins us now from Singapore. So when it comes to DBS, what was sort of the standout for you?
Well, I mean, it beats estimates on all aspects, from lending income, fee incomes, particularly wealth income that surged more than 47%. The CEO also guided for a better year this year. In 2023, DBS already posted a record earnings where the number topped 10 billion Singapore dollars. And this year so far, CEO Piyush Gupta said it would be even better.
And what stood out to you in terms of asset quality as well? Do you think that remains manageable for the lender?
Yes, Singapore banks typically have lower than peers NPL. I mean, the bad assets stood only at 1.1% of total assets. So it's not just manageable, it's quite good. It's a good sign, Heidi. That's one thing that I would like to add as well.
Please continue, yes.
Okay, that's one. Yes, one thing I would like to add is that some analysts pointed out that traditionally first quarters for DBS are the best one. So we may expect to see muted quarters going down the road. That's it.
All right. Chanyaporn and Chanjaro in there. Thanks very much. That was our senior Asia finance reporter in Singapore. And let's stick with banks because Standard Chartered is also releasing its first quarter earnings later today. Analysts are going to be focused on its plans to return capital to investors and its progress on pushing down costs. For more, let's bring in our Asia finance reporter, Denise Wee. And Denise, we just heard there that this is typically a good quarter for DBS. Is it the same sort of story for Standard Chartered as well, do you think? What can we expect later?
I think profits might slip a little compared to last year, but overall, decent profits. I think that the main businesses that are expected to do quite well are basically the financial markets, which is a trading arm, given that volatility has been up. And also wealth, similar story to DBS, I suppose, not quite the same, but they've seen strong inflows, a lot of customers opening up accounts in mainland China, inflows from, say, other banks, like Credit Suisse, sort of going under. So I think those are the sort of focus areas for analysts. The other thing that we're kind of looking at is Standard Chartered has announced a Fit for Growth program in the last quarter, basically cost cutting, streamlining the business, improving digitalization. So I think analysts will be looking for more progress on how that's going, basically.
What was the outlook that we heard when it comes to China?
I think with China, yeah, that's something we have to watch out for. The previous quarters, there was a charge against the Bank of Bohai stake. It'll be interesting to see if there are any write-backs, any change in tone. They've had issues with NPLs in China, which have been persistent even though they've been coming down. We saw HSBC recent quarter has been quite improvement on that front. So for us, I think we're watching if it's an improvement as well if we see these NPLs coming down.
What about expectations for cost management?
So yeah, I think that will be a focus, along with the Fit for Growth program, which is overall supposed to help simplify the bank, reduce costs, reduce overlaps. They've also, the bank has also announced some management changes. For example, they have 2 new co-heads of the Corporate Investment Bank. So it'll be interesting to see how they're going to drive the business forward, in addition to how to keep a lid on costs.
That was our Asia finance reporter, Denise Wee, there ahead of Standard Chartered releasing its earnings later today. But on the earnings front as well, just bringing you some news crossing the terminal here. We've got the entertainment company Haidi as well in Seoul that has reported its numbers. Actually a miss on estimates for operating profits. That came in at 14.4 billion won. That's down more than 70% on the year. And the estimate actually had been for 24.2 billion won. So again, quite a significant miss there on expectation. Sales, likewise, we saw them coming in at 360.9 billion won. The estimate had been for just over 412. So again, a big gap there between what analysts had been predicting versus the numbers that came through. Net basis, 10.8 billion won. Again, the estimate for nearly 20 billion won instead. Still, though, Haidi is actually managing to stay in positive territory as we head through the morning session. But be sure to tune in to Bloomberg Radio to hear more from the day's big newsmakers and get in-depth analysis from the Daybreak team, broadcasting live from our studio in Hong Kong. You can listen via the app, Radio Plus, or on BloombergRadio.com. We have more ahead. Stay with us.
China's top climate chief is warning the climate fight will be too costly without China. Zhenmin spoke exclusively to our Chief North Asia correspondent Stephen Engle and says Western decoupling could cost the global economy trillions of dollars.
If the Western countries continue to insist to decouple from the imports of the China products for clean energy, it will cost the world for maybe additional $6 trillion. It means a 20% increase of the overall cost. We need to maintain the low cost. Otherwise, nobody's going to afford for this energy transition process.
And officials in the U.S. and Europe claim that China is giving unfair subsidies, and that has led to the situation we're in right now that could distort global trade in these clean products. How do you respond?
I think if both U.S. colleagues, European colleagues, going to talk with our Chinese enterprise, you can see all these renewable energy equipment technology, they are innovated and developed and manufactured by our private companies. This is very unique, very unique. I think private companies normally they don't receive any government subsidies. I think we should really highly appreciate the dedication and contribution by these enterprises. So after more than a decade of their hard efforts, now we have cheaper both solar and wind products, which were now affordable to start the energy transition. I think that this is good for both for China and both for the world.
While we're talking about overcapacity, we have to also talk about the domestic economy here because we've been seeing profitability sink at a lot of these solar companies and EV companies. Price wars are driving down their margins. What does that do to the climate fight? If the world is bifurcated on trade,
we can talk about capacity in two different ways. For the global demand, as well as China domestic demand, we're still on high demand for the renewable energy products. Because for the Chinese government, I think we're determined to increase our renewable energy capacity to a high percentage, maybe over 80%. I think for the next decade, we're still in the process of increasing our renewable energy capacity. Globally, I think that's much slower than what the Chinese were doing. So there'll be high demand for the renewable energy. For the so-called overcapacity among the manufacturers, among our Chinese manufacturers, it's a temporary issue. It'd be also good that it be through this kind of competition, they can continue to improve their manufacturing and make much more better products.
China's Special Envoy for Climate Change, Zhenmin, speaking exclusively with Bloomberg's Stephen Engle there in Beijing. Take a look at how we're tracking when it comes to U.S. futures. Of course, we saw that late reversal in the U.S. equity rally as investors continue to pass through the communication from Fed Chair Jay Powell after that FOMC meeting. Rates staying on hold, but of course, persuasive evidence would be needed for any rate hike in the future. Certainly a lot less hawkish than what markets had been positioning for. We are seeing a turnaround, though. S&P futures looking pretty positive. We saw upside when it comes to NASDAQ futures from a little bit earlier on there as well. Taking a look at how we're setting up when it comes to trading in China, we continue to see that sort of revival of Chinese equity sentiment there. TAIEX futures a little bit to the downside, about 0.3% softer. Watching dollar China as well with a pullback in the dollar and some of that sort of benefiting Asian FX being able to take a breather. That big move, of course, in the yen. Speculation as to where the intervention was behind that remains front and centre. That is it for Daybreak Asia. Our markets coverage continues. We look ahead to the start of trading in Hong Kong, Shanghai and Shenzhen. The China Show is next. This is Bloomberg.